let's look at another example. This would be exercise 9-8. On January 1st, 2018, Splash City issues $500,000 of 9% bonds due in 20 years, with interest payable semi-annually on June 30th and December 31st each year. Assuming the market interest rate on the issue date is 10%, and the bonds will issue at $457,102. Complete the first 3 rows of an amortization schedule. So we know the carrying value, or the issue date, is $457,102. So that is the first thing we're going to do on January 1st of 2018, show that carrying value of $457,102. Now the cash paid will always be the face amount of the bonds times the stated interest rate. Since they're issued semi-annually, it's going to be $500,000 times 4.5%. That is the cash that will be paid of $22,500. We then figure out what the interest expense is. It will be the carrying value times the market interest rate. The $457,102 times the market interest rate of 5% each period is $22,855. The difference, the interest expense minus the cash paid, is $355. Since these were issued at a discount, that increase will be added to the carrying value. Next, we're going to, the cash paid is going to be the same amount, but the interest expense is going to be the new carrying value times the market rate of interest. So the $457 times the 5% rate per period is $22,873. Now, the difference between 3 and number 2, column 3 and 2, is $373. That amount will get added to the carrying value. So you'll see that even though it's issued at a discount and it starts with a carrying value, those increases in carrying value, column 4 gets added to the carrying value. So by the time we reach the 20 years, our carrying value is going to equal the face amount on the bonds. Then it says here, record, excuse me here, assume the market interest rate on issue is 10%. The bonds will issue at $457. Record the bonds on January 1st and the 2 semi-annual interest payments. Looks like we did that. I don't know quite what I'm screwing up on there. Let's check your understanding. Which of the following statements is true for bonds issued at a discount? The stated interest rate is greater than the market rate. The stated interest rate is less than the market rate. Or the stated interest rate equals the market rate. Or the stated interest rate is unrelated to the market rate. What do you think there? Remember, for bonds to be issued at a discount, the stated interest rate is going to be less than the market rate. Bonds will be sold at less than the face value or at a discount when the stated interest rate is less than the market rate. Okay. Now we're going to talk about the retirement of bonds. When the issuing corporation buys back its bonds from the investors, we say it has retired those bonds. The corporation can wait until the bonds mature to retire them, or frequently the issuer will choose to buy the bonds back from the bondholders early. Regardless of whether bonds are issued at face amount, discount, or a premium, their carrying value at maturity will equal their face amount. So California Coasters records the retirement of its bonds at maturity as shown here. A debit to bonds payable to zero out that account, and a credit to cash. Now, earlier we noted that a call feature accompanies a lot of bonds, allowing the issuer to buy back bonds at a fixed price. Even when bonds are not callable in this way, the issuing company can retire bonds early by purchasing them on the open market. Regardless of the method, when the issuer retires debt of any type before its scheduled maturity, the transaction is an early extinguishment of debt. Let's return back to our California Coasters example, issuing 100,000 of 7% bonds maturing in 10 years when other bonds of similar risk are paying 6%. The bonds were issued on January 1st, 2018, above face amount at a premium at $107,439. The carrying value of the bonds 1 year later on December 31st, 2018 is $106,877. When interest rates go down, bond prices go up. If the market rate drops to 5%, it will now cost $114,353 to retire the bonds on December 31st, 2018. The bonds have a carrying value on December 31st, 2018 of $106,877, but it will cost the issuing company $114,353 to retire them. California Coasters will record a loss for the difference between the price paid to repurchase the bonds and the bonds' carrying value. California Coasters records the retirement as shown here. We have got the bonds payable gets reduced to zero. The premium on bonds payable needs to be reduced to zero. The cash amount is the $114,353, and the difference would be either a loss or a gain. Now in this scenario, it's going to be a loss because we had to purchase them for $114,353, but the carrying value was only $106,877. No gain or loss is recorded when bonds are retired at maturity under normal circumstances. For bonds that get retired before maturity, we then will record a gain or loss on early extinguishment equal to the difference between what we're paying for the bonds to repurchase them and the bonds' carrying value. Let's look at a question here. A company retires a $50 million bond issue before maturity when the carrying value is $48 million, but the market value is $54 million. Is the company going to record a loss of $6 million? A gain of $6 million? Neither a gain or loss? A debit to cash of $54 million. What do you think there? It's going to be a loss. The market value's at 54. and the carrying value is at 48. So we will have a credit to cash of $54 million. To compute the gain or loss, oops. Compare the bond's carrying value to the market value. Whoops. Since the market value is 54 and the carrying value is 48, that's what gives you your loss. Let's look at exercise 916. On January 1st, 2018, Splash City issues $500,000 of 9% bonds due in 20 years with interest payable semi-annually on June 30th and December 31st each year. The market interest rate on the issue date is 10% and the bonds are issued at $457,102. Using an amortization schedule, show that the bonds have a carrying value of $458,633 on December 31st, 2019. So as you see, what we're going to do is begin the carrying value with what they told us, $457,102. The cash paid will always be the stated rate and the stated bond amount, $500,000 at 9%. So that is semi-annually. 500,000 times 4.5% is the $22,500 cash. That will remain the same. The interest expense will be your carrying value plus the market rate. The $457,102 times the market rate of 10%, which semi-annually is 5%, is $22,855 for June 30th. The difference, the increase in carrying value of $355, is the difference between the cash paid and the interest expense. That increase in carrying value gets added to the carrying value for a new carrying balance of $457,457. We continue to show the interest expense by the carrying value times the market rate. We take the difference between the interest expense and the cash paid to then amortize our discount, add it to our carrying value. We continue to do that until we get to December 31st of 2019 to show that our carrying value is in fact the $458,633. If the market interest rate drops to 7% on December 31st, 2019, it will cost $601,452 to retire the bonds. Our job is to record the retirement of the bonds on December 31st, 2019. Now remember, what was the carrying value on December 31st, 2019? $458,633 is our carrying value. So the bonds payable of $500,000 just wipes out our bond account. We know the discount on bonds payable needs to be also zeroed out. The cash of $601,452 is credited. Now I want to go back and talk about the bonds payable of $41,367. We know that our carrying value here is $458,633. That carrying value is the difference between the face amount minus the discount on bonds. So that is our carrying amount. So we need to zero both out, the bonds payable and the discount on bonds payable. And that gives us our loss. Our loss is $142,819. Next, we're going to look at debt analysis. we're going to make some financial decisions based on using long-term liquidity ratios. Business decisions include risk. Failure to properly consider risk is one of the most costly, yet it's kind of common, mistakes investors and creditors make. Long-term debt is one of the first places decision makers look when trying to get a handle out on risk. There are two ratios that measure financial risk related to long-term liabilities. One is called debt to equity, and the other is called times interest earned. Now, as you see on this slide, Six Flags went into bankruptcy due to difficulties in repaying its long-term debt. This slide describes steps taken by Six Flags to try to reduce its long-term debt. It says it entered into agreement to sell 3 of its water parks and 4 of its theme parks. The disposition of these 7 parks is a key component of the company's overall strategy to reduce debt and enhance operational and financial flexibility. Company management stated its intent was to reduce debt by several $100 million over the next several years. Now, to measure a company's risk, we often calculate the debt to equity ratio. The computation of this ratio is shown in this slide. The debt to equity ratio is a measure of financial leverage. Leverage enables a company to earn a higher return using debt than without debt. In the same way, a person can lift more weight with a lever than without a lever. Debt requires payment on specific dates. Failure to repay debt or the interest associated with the debt on a timely basis may result in default or perhaps even bankruptcy. Other things being equal, the higher the debt to equity ratio, the higher the risk of bankruptcy. When a company assumes more debt, risk increases. Debt also can be an advantage. It can enhance the return to stockholders. If a company earns a return in excess of the cost of borrowing the funds, shareholders are provided with a total return greater than what could have been earned with equity funds alone. Unfortunately, borrowing isn't always favorable. Sometimes the cost of borrowing the funds exceeds the returns they generate. This illustrates the risk-reward trade-off that's faced by shareholders. The debt-to-equity ratio is higher for PepsiCo. Debt to equity is a measure of financial leverage. Thus, PepsiCo has higher leverage than Coca-Cola. Leverage enables a company to earn a higher return using debt than without debt. In the same way, a person can lift more weight with a lever than without it. PepsiCo is assuming more debt, and therefore its investors are assuming more risk. Remember, this added debt could be good or bad depending on whether the company earns a return in excess of the cost of borrowed funds. Lenders require interest payments in return for the use of their money. Failure to pay interest when it's due may invoke penalties, possibly leading to bankruptcy. A ratio often used to measure this risk is the times interest earned ratio. This ratio provides an indication to creditors of how many times greater earnings are than interest expense. A company's earnings, or we can call it profitability, provide an indication of its ability to generate cash from operations in the current year and in future years, and it's cash that will be used to pay the interest payments. So the higher a company's earnings relative to its interest expense, then the more likely it's going to be able to make current and future interest payments. Remember that interest is one of the expenses that we get to subtract in determining net income. So to measure the amount available to pay interest, we need to be able to add the interest back to net income. Likewise, because interest is deductible for income tax purposes, we need to add back tax expense as well. So the higher a company's earnings relative to its interest expense, the more likely it will be to make current and future interest payments. Coca-Cola has a higher times interest earned ratio than PepsiCo, indicating that Coca-Cola is better able to meet its long-term interest obligations. However, both companies exhibit strong earnings in relation to their interest expense, and both companies appear well able to meet interest payments as they become due. A key point to note: the debt to equity ratio is a measure of financial leverage. Taking on more debt, which means higher leverage, can be good or bad depending on whether the company earns a return in excess of the cost of borrowed funds. The times interest earned ratio measures a company's ability to meet interest payments as they become due. Let's check your understanding here. Which of the following ratios best measures financial leverage? Is it return on assets, inventory turnover, times interest earned, or debt to equity ratio? The debt to equity ratio is the measure of financial leverage. Let's look at some problems here. So problem 9.7b provides us with selected financial data for Surf City and Paradise Falls. Show the total assets of each for 2018 and 17, the total liabilities, the total stockholders' equity, the sales revenue, interest expense, tax expense, and net income. Selected financial data are as follows. Calculate the debt to equity ratio for Surf City and Paradise Falls for the most recent years. Which company has the higher ratio? So the debt to equity will be total liabilities divided by stockholders' equity. As you see here, Surf City's debt to equity is 1.39. Paradise Falls' debt to equity is 0.64. Calculate the return on assets for Surf City and Paradise Falls. Which company appears more profitable? So return on assets, we're going to take the net income divided by the average total assets. We calculate the average total assets by taking the assets for 2017 and 2018, dividing them by 2. Surf City has return on assets of 0.1%, where Paradise Falls is 3.3%. Then we've got the times interest earned ratio for Surf City and Paradise Falls, which companies better able to meet interest payments as they come due. Net income plus interest plus taxes divided by interest. The Surf City's times interest earned ratio is 1.1. Look at Paradise Falls, 4.9. There you have it, guys. This is a full chapter. There's a lot to cover in this. Good luck.